The Bank of England have once again increased interest rates in an attempt to try and control inflation. However, the big question is, in the process, are they about to completely destroy the buy-to-let sector? Hey, if you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 plus years of property investing experience to ultimately help you get further faster in your own property investing business. So on Thursday, the Bank of England, they decided to increase interest rates again. They took them from 2.25% to 3%. That's an increase of 0.75%, and that's the biggest single increase in more than 30 years. Andrew Bailey, the governor of the Bank of England, has indicated that more rises are likely to come. And ultimately, what they're trying to do is control inflation. Inflation is now running at more than 10%, which is a major problem for the country and the economy. And so this is their way of trying to control that. But in an attempt in trying to control inflation, they are creating other problems. Some of the market predictions are that interest rates will rise to 5.25% next year. This means there's a rise of more than 2.25% yet still to happen. Many of the forecasters are saying this will create a long recession, in fact a 2-year recession. But the purpose of us bearing with all this pain is so we can avoid bigger problems and bring inflation down. The Bank of England want to get inflation back under 2%, which is what their initial target's been. To give you some context to these rate rises, the current rate is the highest it's been since 2008. And this has been the 8th consecutive rise in interest rates. Less than a year ago, the rates were 0.1% and now at 3%. When the Bank of England increase rates in this way, ultimately what they're trying to do is make the cost of money more expensive. And what that means is that businesses are paying more for financing, mortgage holders start paying more in terms of their monthly payments. Why would they want us to do that? That's because they want to reduce the amount of spending we have and our spending ability. And what that would do is slow down the economy. And effectively what happens then, inflation rate starts to fall, where it's currently more than 10%. They want to get it back down to that 2%. There are about 2 million mortgage holders, that includes homeowners and buy-to-let landlords, whose mortgage interest rates will increase immediately. Effectively, they're on what's called a variable rate. Then there's about 1.8 million whose rates will come off their current fixed period next year, and those rates will then increase for them then. And it's estimated for most people, they'll see their costs increase by about £3,000 a year. So how is this going to impact the buy-to-let housing sector, I hear you ask? Well, let me explain. Let's first talk about if you're taking on a new buy-to-let mortgage and a new purchase. So your interest rates are probably going to be in the region of 5 to 6% for a 5-year fixed buy-to-let mortgage. But really, you should be stress testing around 7 to 8%. What that means is that you should do your figures and your calculations assuming the rate was 7 or 8%, that sort of region, so that you know if the rates increase. What you also need to consider is a 1.5% multiplier for rental coverage. Now what this means is that the lender, your mortgage provider, wants to see that your mortgage is lower than your rent payments. Clearly that you need to make a profit for the thing to be viable. And they'll vary in terms of what they look at. You know, basing it on 1.5% is sensible, but it could be anything from 1.25% right up to 1.5%. So let's look at this as an example. So let's say we've got a £100,000 mortgage. So we've got a £100,000 mortgage and it's an 8% interest rate. So that means your monthly payments are going to be £667 per calendar month. And then you need to add a multiplier on a 1.5%. And that will then take that payment to £1,000. So what that essentially means is on a £100,000 mortgage, when you're paying 8% interest, that your monthly payment is £667. But the rent that your lender is expecting you to be receiving should be in excess of £1,000 in order for them to lend you the money at that rate to be able to do this purchase. The challenge is most buy-to-let investors are paying way more than £100,000 for their investments and they're borrowing more. So let's look at that, what a typical example might look like. So if we look at a typical purchase price at £290,000, which is the average price of a house, it doesn't necessarily mean you'll be purchasing at that level, but just to use it as an example here, you're borrowing 75% from the bank as a 75% mortgage, which means you're borrowing £217,500. And at 8%, that would be £17,400 a year that you're paying interest to the bank on that £217,000, which equates to £1,450 a month as your monthly mortgage payment. But then when you add the multiplier on that, the 1.5, that would take that to £2,175. So what that means is that the rent would need to be about £2,175 on that sub £300,000 house in order for the lender to provide you the money. Now, clearly, in most cases, that's not workable, it's not viable, and it doesn't make sense. So that's going to cause a slowdown in people buying property because the numbers just don't add up, the numbers don't work. Let's now look at the alternative scenario of somebody already owns a property as a landlord and they're going to be remortgaging, or they're coming off their current rate. If we look at this example where the landlord may have been on a 3% rate, say previously, before remortgaging, that means their annual interest would have been £6,525, and when you divide that by the 12 months, about £540 a month. And then if you look at the difference between that and what the new rate will be, that's a difference of £906. Now, again, for landlords, it doesn't work, it doesn't make sense because they don't have that kind of margin. So ultimately, they either have to start increasing their rents, which means then the tenants start suffering as well. And for some tenants, they can't afford those kind of increasing rents as well. Or alternatively, it means they sell up and they just walk away from the buy-to-let sector. And in both cases, it means tenants suffer, there's shortage of stock in the marketplace, or the rents are going up. Now, ultimately, what needs to happen? The government either needs to make a decision that either going to create more accommodation and more housing for people that need it, or it needs to support landlords and investors and developers to encourage them to be able to create the homes that they can provide in a profitable way, so that they can service that sector. Now, one of these two things needs to happen. I really don't know what's going to happen going forward right now. What I do know is that the market changes, opportunities change, and you need to look out for those opportunities. Hey, if you enjoyed this content, then do me a favor, click on my face over here to subscribe to the channel. That way you'll get notified when we're releasing more videos just like this one. And then what to do next is watch this video over here, where I explain how you can use inflation as an advantage and as a benefit in a property market just like this to be able to help and grow your property business. So I look forward to seeing you on this video next.